Here is the number they leave out of the anniversary specials: $19.2 trillion. That is how much household wealth America lost in the financial crisis, peak to trough, according to the United States Treasury. 19.2 trillion. Sit with that. Nobody can actually picture it. That's the point. And here's the story you were told about it. A freak storm, a 100-year flood, a perfect, unlucky alignment that nobody could have seen coming. Bad weather, act of God. Move along, nothing to learn here. Throw that story out. The official United States panel that investigated this, the Financial Crisis Inquiry Commission, read all of it and wrote one sentence that ends the weather metaphor forever. Quote, "The crisis was avoidable. It was the result of human action and inaction, not weather, people. And don't let anyone tell you nobody saw it coming." In 2007, Fed Chairman Ben Bernanke told Congress the subprime problem seemed, quote, "likely to be contained." It wasn't. Meanwhile, a regulator named Brooksley Born had warned years earlier and was shut down, and short sellers were betting their own money it would all burn. The warnings were there. Ignoring them was just more profitable. So this isn't a film about a storm. It's a film about a machine. A machine that took a home loan that was never going to be repaid and turned it, link by link, into the safest investment on earth, on paper. Then it blew up, and the people who built it got paid. Here's how we'll do this. We follow $1, one bad mortgage all the way up the chain, and at every link, watch for one small, quiet thing. Someone takes a cut. Someone made a fee on that. Remember that line. We're going to say it a lot. Because once you see the fee, you see the whole crime. And here's the part that should genuinely make you angry. Almost none of it was illegal. A $19 trillion heist, and it was mostly perfectly legal. Let's follow the money. It starts on a porch. Someone wants a house. A broker writes them a loan. In the old, boring, sane days, that lender kept the loan, which meant the lender cared intensely whether you could pay it back. Their money was on the line for 30 years. By 2005, that link was cut. The broker who signed you up didn't keep the loan. They sold it within days, banked a fee, and walked away. Notice the trick. The second you sign, their risk is zero and their fee is locked in. Someone made a fee on that. Think about what that does to the incentive. If you don't keep the loan, you don't care if it's good. You care if it closes. The dream customer isn't the careful one who can pay. It's anyone who will sign. No income. Fine. No job. We've got a loan for that. They had a nickname for these. Liar loans. So let me be blunt. The product was bad on purpose. A loan to someone who couldn't pay wasn't a glitch in the system. It was the system, because the person making it had already figured out how to sell the risk to someone else before your first payment was even due. Now Wall Street has millions of these loans piling up, good and rotten. And here's the question that built the bomb. How do you take a pile of mortgages that might not get paid and sell it to the most cautious investors alive? Pension funds, insurers, people legally only allowed to buy safe things. How do you turn lead into gold? Here's the trick, and I mean that as an insult. You pour thousands of those mortgages into one part. That part is a bond, a mortgage-backed security. Investors buy slices, the monthly payments flow up to them. Bundle enough loans, the theory went, and the bad apples just average out. Then they went further. They sliced the part into layers. The top layer gets paid first, so it's safe. The bottom absorbs the first losses, so it's risky. And here's the magic they claimed. Even a pot full of subprime junk could have a top layer so protected it earned the highest grade in finance. AAA, the same grade as United States government debt. Who decides it's AAA? Not the bank. You need a referee, a credit rating agency. Moody's, Standard & Poor's. Their entire job is to tell the world what's safe. A pension fund in Norway can't fly to Florida and inspect the loans, so it trusts the stamp. The stamp is the whole game. So, who pays the rating agency? You'd assume the investors relying on the rating pay for it. They don't. The bank that builds the bond pays the agency to rate it. Read it again. The company being graded writes the check to the grader. It's called issuer pays, and on its face, it's insane. Picture a student who pays the teacher for her own grade. And if she doesn't like her B, she walks down the hall to a teacher who will give her an A and takes her money with her. That's the rating industry. The agencies competed to hand out A's. Someone made a fee on that, on every single bond they blessed. And they blessed an ocean of them. AAA, AAA, AAA on bonds stuffed with loans nobody verified. The math only worked if house prices never fell, anywhere, all at once. That was the load-bearing assumption under the whole world economy. House prices always go up. Hold on to that. Then it got worse. The banks had so many leftover risky slices that they ran the trick again. They poured the bad slices into a new part, a CDO, and got the top of that stamped AAA too. Garbage, rebundled, restamped, resold. And when the music stopped, the overwhelming majority of those AAA mortgage bonds got downgraded to junk. Safest thing in finance, on paper. Worthless, in fact. Now the part that turned a bad mortgage market into a global extinction event. So far, the losses are at least capped at the actual bonds. A few trillion in bad mortgages. Painful, survivable. Except Wall Street found a way to bet on those bonds over and over and over again. The instrument is a credit default swap. Forget the name. It's insurance. You hold a mortgage bond, you're nervous, so you pay a bank a fee every year, and if the bond goes bad, they pay you out. Insurance. Someone made a fee on that, collecting the premium for promising to pay if the unthinkable happened. Here's the catch that should drop your jaw. To buy this insurance, you didn't have to own the bond. I can take out fire insurance on your house. So can 1,000 strangers. Now one house burning down doesn't pay out once. It pays out 1,000 times. The bet became bigger than the thing it was betting on. How much bigger? This shadow market of swaps grew to a notional value of roughly $60 trillion by 2007. I'll be straight with you. That number is contested because notional overstates what was truly at risk. But even the careful version dwarfs the entire world economy. A casino built on top of a casino. And one company sat at the center, riding insurance like it was free money. EDGAR, one of the biggest insurers on earth. A single London office sold tens of billions of these swaps, booked the profit, and set aside almost nothing to actually pay out. Why? Say it with me. House prices always go up. The payout would never come. Last piece, and it's the one that turned a fire into the apocalypse. Leverage. The big investment banks weren't betting their own money. They borrowed about $30 for every $1 of their own. 30 to 1. Bear Stearns was around 33 to 1. Here's why 30 to 1 is a death sentence. Just arithmetic, no finance degree. If $1 of yours holds up $30 of assets, those assets only have to fall about 3%, 3, and your dollar is gone. Wiped out. Bankrupt. And remember what every bet secretly rested on. That house prices would never fall. So what do you think happened next? House prices fell. That's the whole trigger. The one thing the machine assumed could never happen, a nationwide drop in home prices happened. And because everything was leveraged 30 to 1, that small drop didn't dent the banks. It detonated them. The collapse wasn't bad luck. It was arithmetic coming due. First domino, March 2008. Bear Stearns, 85 years old, runs out of cash in days because everyone it borrowed from wanted their money back at once. The Federal Reserve steps in. JP Morgan Chase offers to buy the whole firm for $2 a share. $2. So humiliating it was later raised to 10. And the Fed backstopped the deal with a facility of about $30 billion. And here's the tell that nobody was watching the machine. 5 days before Bear collapsed, the famous TV stock picker Jim Cramer was asked about it on CNBC. His answer, Bear Stearns is fine. In fairness, he later said he meant the deposits were safe, not the stock, and that's a fair clarification. But right up to the cliff edge, television was telling you the ground was solid. Then the floor gives way everywhere. September 7th, the government seizes Fannie Mae and Freddie Mac, the two giants standing behind half the mortgages in America, and takes them over. The Treasury would eventually draw about $187.5 billion to keep them alive. Money that, by the way, was later more than repaid in dividends. The two pillars of the mortgage market nationalized in a weekend. Then the week that broke the world. September 15th, 2008. Lehman Brothers, the fourth largest investment bank in the country, 158 years old, files for bankruptcy. $639 billion in assets, still the largest bankruptcy in American history. This time, no rescue. They let it die. The photos of employees carrying their things out in cardboard boxes became the image of the crisis. And here's a detail that proves they knew. A court-appointed examiner later found that in its final months, Lehman used an accounting trick, Repo 105, to shove about $50 billion of debt off its books right at the end of each quarter. Just long enough to take the photo, to look less leveraged on the exact days anyone checked. That's not a firm caught by a storm. That's a firm hiding the leak. September 16th, the very next day. Remember AIG, the insurer that sold all those swaps and saved nothing to pay them. The bill came due at once, and AIG couldn't pay. If it fell, it took down every bank it had insured. So the Fed stepped in with a loan of up to $85 billion and took nearly 80% of the company in return. The total commitment to AIG would reach $182 billion. And in that same weekend, another giant arranged its own funeral. Merrill Lynch sold itself to Bank of America rather than be next, announced at around $50 billion. By the time the deal actually closed, Merrill was worth closer to $29 billion. That's how fast value was evaporating. A firm lost more than 40% of its price between the handshake and the signature. Then September 25th, Washington Mutual, $307 billion in assets, seized by regulators. The largest bank failure in American history, sold off to JP Morgan that same night. Days later, Wachovia went the same way, swallowed by Wells Fargo to stop it collapsing. In weeks, the names that defined American finance were dead, seized, or for sale. The dominoes weren't falling by chance. The leverage had wired them together years before. So the system is on fire, and the people who built it come to Washington, not with a request, a demand. The Treasury Secretary was Hank Paulson, who, hold this detail, had until 2 years earlier been the chief executive of Goldman Sachs. The former Wall Street banker, now running the Treasury, telling Congress to hand Wall Street a blank check immediately or the economy ends. The check was called TARP. Congress authorized up to $700 billion. Now I have to be a careful, honest narrator because this is the most misreported number in the whole story. You'll hear the bailout cost taxpayers $700 billion. That is not true. Stay with me because the truth is stranger and in its own way worse. Most of that money was a loan or an investment, and most came back. On the final scorecard, the program that put money into the banks didn't lose a cent. It turned a profit, about $16 billion for the Treasury. The bank rescue made money. The total net cost of TARP landed around $31 billion, and that piece was mostly homeowner relief and the auto industry. The banks paid it back with interest. And here's the part that should upset you more than any fake headline. When the government rescued AIG, the money didn't stop at AIG. It flowed straight through. AIG owed those swap payouts to other banks, and the rescue paid them 100 cents on the dollar. Par, full price. No haircut. The biggest recipient, a French bank, Société Générale, $16.5 billion. Right behind it, Goldman Sachs, Paulson's old firm, $14 billion. So look at the two columns. One side, the banks, bailed out, paid at par, bonuses largely intact. The rescue on the whole made the treasury money. Other side, roughly 8.7 million Americans lost their jobs. Somewhere between 6 and 10 million families lost their homes. And $19.2 trillion of household wealth, the number we started with, gone. One column got made whole, the other got a recession. That asymmetry is the story. So you ask the obvious question. If it was all this rotten, somebody committed fraud, right? Somebody went to prison. Almost none. Almost no senior Wall Street executive went to prison for the crisis. Because remember, most of the machine was legal. That was the whole trick. There's one case worth knowing, because it shows they knew. In 2010, the SEC charged Goldman Sachs over a deal called Abacus. The charge: Goldman built a mortgage product, sold it as a good bet, and didn't tell buyers that a hedge fund had helped pick what went in it, specifically so it could bet against it. Goldman settled for $550 million, the largest such penalty against a Wall Street firm at the time, without admitting or denying wrongdoing. And there's one email, genuine, entered into the record, that says it all. A young Goldman banker named Fabrice Tura, who nicknamed himself the Fabulous Fab, wrote to a friend as the market cracked. He described standing in the middle of these complex, highly leveraged, exotic trades he created, quote, without necessarily understanding all of the implications. And of the whole thing, the entire building is about to collapse anytime now. A jury later found Tura himself civilly liable, the only individual a jury held responsible in the entire crisis. He understood the implications fine. He just made a fee on them first. And when Senator Carl Levin read one of these deals back to Goldman's own executives, an internal email where Goldman's people had called one of their products, I'm quoting, one shitty deal, he asked the only question that mattered. How much of that shitty deal did you sell to your clients? They knew exactly what it was. They sold it anyway. Someone made a fee on that. Even the high priest admitted it. Alan Greenspan, for almost 20 years the most trusted economist on the planet, the man who swore the market would always police itself, sat before Congress in October 2008 and said, quote, I found a flaw. He said he was in a state of shocked disbelief. The whole theory that banks would never blow themselves up, the chairman himself admitted on the record, was wrong. Now here's why I dragged you through all of it. The porch, the bundle, the bought rating, the side bet, the leverage, the fee at every link, because the machine wasn't dismantled. It just got new clothes. The exact same playbook, make a loan, bundle it, get it rated, sell the risk to someone else, keep the fee, is running right now. It's running in subprime auto loans, bundled and sold just like the mortgages. It's running in buy now, pay later. It's running in private credit, the fastest growing corner of finance, rated by the same agencies. And the issuer pays conflict, the company being graded still paying the grader, was never actually fixed. So here's your rule. Whenever someone earns a fee for making a risk they don't have to hold, the 2008 machine is running. Watch for the fee. The fee is the tell. They told you it was a storm, 100-year flood. Nobody could have known. But the official commission said it plainly. It was avoidable. It was human action. The math never worked. The incentives were rotten from the porch to the trading desk. And at every link in the chain, while millions lost everything, someone, quietly, legally, reliably made a fee on that. You were sold a story. Here's the number underneath it. $19.2 trillion. Don't let anyone tell you it was the weather.